The Fed's two-day meeting kicks off today, and we've got the results of the latest Fed survey. Steve Liesman is here. He joins us with more on what he found. Hey, Steve.
Becky, good morning. 43 economists, strategists, and fund managers polled, and they're pretty much right about the next stuff I'm about to show you. 100% see a 25 basis point rate cut. 92% say that next rate cut after one we are supposed to get tomorrow would come in December. Note that's only one more after this one. And then this is interesting. 1.56 is the average fund rate seen for the year end of 2020. So another one dialed in for sometime next year, or a debate about how many. There's one or two. Kind of interesting results on what should the Fed do. 51% say the Fed should cut. And some of those, by the way, say the Fed should cut by 50 basis points. And we'll get to that in a second because the probabilities this morning in the futures market have changed. 44% say the Fed should not do anything. Well, why will the Fed do anything? 25% say it's the trade. Well, 25% of the reason is put on the trade war, another quarter on the weak economy, low inflation. We took a couple of the reasons out, but pressure from the market at 18%, and people do not believe that the market is reacting to pressure from President Trump. Just 8% of the reason for the rate cut. Give you some of the commentary here. Kathy Bastianic, chief U.S. financial market economist at Oxford, says, while the Fed does not want to underwrite the ongoing trade war, it has no choice but to buffer the deleterious impact it has on the economy. In total, we look for 4 cuts in 2019, completely unwinding the 4 rate increases in 2018. Art Hogan, chief market strategist at National Security, says economic data and financial conditions are not exactly screaming for rate cuts here, but someone at 1600 Pennsylvania Avenue sure is.
You know, while you were showing those numbers, I was thinking about what we've been hearing from Mike Santoli for the last week or two, is that after the last couple of times we heard from the Fed when they cut rates, you saw the market sell off because it was expecting everything they got and didn't get any surprises that would have made them a little more bullish on things. If you have 100% already expecting a 25% rate cut and 92% expecting a rate cut next time they meet in December, it seems like it could be setting itself up for the same position where people expect that this is going to happen. It's not going to be a surprise. Right. It's not going to push stocks higher if they get these things. But if there's anything in the commentary that makes it seem like we may not get a rate cut in December, it could disappoint. The
old mid-cycle adjustment comment that was made. I don't think, look, that stuff matters sort of on a day-to-day thing. I think what really matters for the economy is the total amount of easing that's in the economy. And if you were, for example, to show a chart of the 10-year, which you've completely forgotten was what in November 2018. We've all forgotten this. It was up near above 3%. Remember that? There is a ton of no, you don't, because we forgot. We're all like, rates are low, they're always going to be low. Guys in the back, if you could put up that 10-year chart going back to, say, November or September last year, you'll see it was up there, and there's been a lot of easing. It's come through the mortgage market. It's come through the fixed income market. It's come to the corporate bond market. All those different places, there's all this easing in the economy. The Fed has to meet that easing in the economy, but it's already been delivered by the market.
You know what? I was just thinking of something, and this is not a cynical take on things, but if you were Jay Powell, you have a choice. I'm either doing what Trump wanted me to do, or I'm acknowledging he was right.
Right.
And neither one, but you could come back and say, well, you caused it yourself with your trade wars. So, I mean, you can always come up with that, that explanation of what happened.
Why are there even 4 people at the table when you can have the entire conversation by yourself, Joe?
What do you mean?
You just answered your own thing. You're right. That's exactly what I would respond.
Oh, yeah. No, because I know you, and I'm looking over, and I'm thinking, I'm just thinking it through. It's like, wow, I might rather admit, I don't know which is worse, admitting that I'm succumbing to the pressure from Trump or saying, oh, my God, you were right in the first place. But then immediately I know you'd say, well, when you do it yourself, it's pretty easy to engender a rate cut by slowing the economy down from your ill-conceived trade wars, right?
I think that's probably a good response, and I think that...
all right. We don't need you. We'll see.
Leave it there. Leave it there.
You can stay.
Joe, there's a reason why other presidents have chosen not to talk about the Fed.
But that's a rare thing. They didn't have Twitter, number one, and we've gone back and people have done reports.
What does not having Twitter have to do with it?
We've gone back and known
he has to use it because it's there?
No, we've gone back and seen that many presidents have jawboned over the years.
Joe, come on, Joe.
You want
to make a list?
Also,
you give me your list. I'll give you my list, and we'll compare the lists.
But definitely social media allows it to be much more widely disseminated from we're just grousing in private about it.
Wait. If you think a president would have had trouble making public his remarks
who was the
about
president?
his criticism
Who was
of
the president that threw the Fed chief up against the wall?
Johnson, maybe, or something like that? Yeah.
Okay,
He used to go around and kick everybody. He did. He had boots and he'd kick them in the shins.